All right, what up, everybody? This is Jeremy Johnson with Escape Velocity Trading coming at you for another market bias update report for Sunday, February 23rd. Starting off, we don't have reviewing for trading last week. I think most of you that follow my channel know that I've been out for the last couple of weeks. I actually was on my honeymoon with my wife. We got married about a year and a half ago, and life has just been so busy that we have not had a chance to actually go and just have a trip. So I have been completely unplugged from the market for the last couple of weeks, and it looks to me like it was a great couple of weeks to be unplugged. Looking at the S&P, kicking right off and going into our charts, reviewing what is going on and what has transpired since my last video a couple of weeks ago. Looking at this just chop at the top end of the chart is really interesting to me, and I want to put this out to a year chart so we can see this in a little bit more clarity. So the last few weeks in January and early February before I took my vacation, we were in this neutral consolidation, basically anywhere on the S&P from 575 up to the $600 level. We did on the S&P, zooming back in here on Wednesday, have technically a confirmation breakout on the S&P right there, closing above that resistance line on the S&P 500. But this is why I always love to look at the futures market as well. The S&P futures market is /ES. So now let's go out and look at Wednesday 219 on the ES chart. If we take that, zoom in on the same time frame, and really look at the price action of what was going on. I have to get rid of my alert here so you can see it. On this, we wicked up above that line on 219, but we closed back down in the range and actually below the recent wicks here as well and the last previous two pivots. So this was not a confirmation on the ES for the futures mark. That means that there was conflicting zones. Those that were trading on /ES did not have a confirmation of a bullish breakout. Those that were looking at the SPY technically did, although even on the SPY, if we go back over to it, a lot of traders don't trade the close on that, but they will actually look for a specific ATR buffer on the close above the resistance zone. So ATR, for anyone that doesn't know, stands for average true range. Basically, it is a simple calculation that just takes the last X number of candles. So right now we're on a daily chart and mine is set for 14 candles. So this ATR box in the upper left of my chart here says 5.8. That means that on Wednesday here, 2/9, if we averaged the daily price movement of the last 14 candles, the average price movement was $5.80, excuse me. So looking at that, we would go from the breakout channel, add $5.80 or whatever percentage of our ATR rule we use for confirming a breakout, and that would actually be the line to trigger in, not the confirmation on the breakout. Now, this is where technical analysis gets a little bit subjective because everyone has slightly different rules based on their style of trading. Some prefer to be really aggressive and play the actual break itself because they want to get the absolute best price that they can for the purchases that they make. And they are willing to give up a little bit of probability or extra confirmation in order to get that better price. Other traders on the more conservative side will give up a little bit of extra price to have a higher probability that that trade is actually moving in the direction that they want to trade. So this is a really important moment here to define what you want your approach to the market to be. How do you want to define a breakout? And these are the types of rules that if you are trading, if you are participating, especially short-term trading in the market, you have to know what your style of trading is and how you want to go about playing these types of setups. So again, for this, some traders probably got faked out here. Then we had a little doji wick action on Thursday, and Friday we had a massacre driving price all the way back down to the daily 50 moving average, which did stop the bleeding on Friday right here at a very important pivot as well back from 212. But if we toss this out onto the weekly time frame, it gets a little more interesting because on the weekly time frame, we are still just in this choppy mess. And if we remove this red candle right here, going back 1 week, and we are on February 10th right here, at that point in time, at the close of that week, This was basically a cup and handle or pennant formation pattern that was looking to push and break out. And the lean was most definitely in the bulls territory from a pure chart price perspective. Now, if we look at our indicators, however, while we were still in bullish territory between 50 and 70 on our RSI, our MACD had crossed over here on 12.9 and was actually in a slight reversal. Anything above zero line, this purple line right here, is considered bullish, but we want this blue line to be above the yellow line on our MACD like it is right here. This, we got a bullish cross, blue line crossing above the yellow line and above the zero line, and then it takes off. And what happens in the price chart? Momentum takes hold and we get a nice, solid, sustained run until the RSI gets a little bit too overextended. The MACD then crosses, and then we have a pullback into moving averages that act as support, and then we go for another run, even though it's not quite as strong, and so on. But this time here, our bullish thesis on the RSI has weakened. We are actually seeing a long-term decrease in the pivots on the RSI, and this is divergence. When pivots on the RSI are decreasing, but the overall pivots of price action are increasing over that same amount of time, this is divergence in action. And the RSI is signaling that the price might be getting over its skis a bit. We might be coming up to a localized top. Now, if we remove that line and look at this again, to me, this pattern that did originally look like a little cup and handle or pennant formation right here with the deep cup down to support, popping up to resistance, little handle of the cup right here, popping back up to resistance. With this red candle out of the picture, this closed right up in the higher end of a resistance and was leaning bullish. But Friday's candle last week shifted the entire narrative of that week's price action. And now this could either bounce back and recover. And if it does push back up into that breakout zone again, and we do get confirmation above, I will be willing to trade that. I will be willing to take that trigger. To me, this actually looks a little bit more like correction territory to me because we got smoked on that. We had a bit higher volume on Friday as well. If we drop this down into an intraday, look at the big red volume candle showing a lot of participation on this downward move coming off of that resistance zone. So to me, I am seeing this as instead of a cup and handle with the cup being here and the little shallow handle being here, I'm actually looking at this as potentially a double or triple top where we have touched this resistance zone 1, 2, 3 times, and the third time we got rejected hard. Now, combine this, we also need to be thinking about our thesis in the market. What is the thesis that is going to make people want to buy this breakout? And to me, if we put this out on a 2-year chart, we have been on a monster run, and a lot of this run has been money still in the marketplace coming off of everything from COVID pandemic, and that is not sustainable. Our government spent a ton of money trying to get us to stave off inflation, to get out of a recession territory and conversations around recession. And that spending is not sustainable long term. So to me, I think we are in a very, very vulnerable place in the marketplace right now. And looking at this, I am seeing the 50-period moving average, which is very, very important, go from a 45-degree angle up to now it is starting to roll over to now it is basically flatlined here. If we get a candle breaking down below this 50 and closing below that 50, to me, next stop is going to be testing the lows back here again around 575 and then maybe down to about 568 on the rising 200 period moving average. And that would equate to basically a 6 to 7% downward movement. So not the end of the world, but definitely a big enough move to make some profit on if that ends up transpiring. So this is a very, very important pivotal moment for the marketplace. And at least on the S&P, I am starting to lean more towards the bearish narrative for the short term here, the next few weeks, until we really see what the new administration's plan is past all of the executive orders that have been coming down the pike basically daily since Trump took office. So going out to the triple Q. Triple Q, we're not going to spend as much time here because it is very, very similar story. On this, we have a little bit of a rising resistance line here. This one actually needs to be removed and redrawn. We have a little bit of an increasing pivot, but we also have a little line in the sand here where we have a little bit of room down to the 50 period moving average and a little bit of room to this extra diagonal for potential support right there. But I am not liking the look of that combined with the RSI's steep decline and the MACD rolling over as well, again with big volume on Friday. So I am not in a rush to be a hero here in the marketplace, and I am probably going to be waiting a little bit longer, even though I've been out of the market here for a couple of weeks. I am going to be waiting a little bit longer here to see how this narrative shakes out. Going out to IWM, we had one of the worst candles we've had at least this year. This was the year mark right here, January 1st. We had a really bad day back on the 18th of December. But other than that, this is the most volatility to the downside that we have seen in a while. And you can look down and see that we had a big red sell candle there as well. We actually transferred from mild or neutral position into bearish territory on the MACD, and we are firmly in bearish territory on the RSI. So to me, this is a stay away chart on the daily. If we toss this out to a weekly, we do have that 50 period moving average right here, and I'm going to set an alert for myself at that. If price crosses below that and closes below it, to me, that's a lookout below, and we are probably coming back down to this gray line right here, the 200 period moving average, which would be at $200 on IWM. Going out to the Dow Jones, this looks a little bit even more like a double top to me. On the S&P, we had more of a cup and handle pattern. Here, we had a deeper retracement initially on the Dow Jones. We did recover, but wicked up and didn't quite recover the same high here. And then we broke down and are actually currently below the weekly 20 period moving average here. To me, this looks like the Dow Jones is coming back down to 418 to about 413, somewhere in that range. Going out to IBIT. On the weekly chart, hasn't done much wrong. I don't love the chop back and forth along the 9 period moving average, and I don't love that the 9 period moving average is starting to roll over here. We do have support from the all important 20 SMA that is still underneath us and pushing up towards support. But if we drop this down to a daily chart, that is an ugly, ugly candle. We came up, we tested up right into the merging 20 and 50 period moving averages, got smoked by it, broke down below the 9, got a big red indicator here. This arrow is one of my proprietary indicators that I have coded to signal when I want to switch from bullish to bearish based on green candles or red candles. And this is not the only indicator that I use, obviously, but it is a strong indication to me when in conjunction with RSI and MACD and the rolling over and curling over moving averages. So not a great look on this. If anything, I am interested potentially in a short-term dip in Bitcoin, probably down for IBIT here, the ETF that tracks Bitcoin, probably back down to 51. If we break that, it's potentially a lookout below. If we toss this out to a weekly chart, the moving average here, we were talking about the 20 SMA is 51.73. So if we get below 51 there, really we could see a retest back down to the 40 or 42 zone, somewhere right in there. And I would consider that to be a good buying opportunity. And I doubt price will stay down at that level for very long, but I am waiting and watching for that because that is something to pay attention to. Going out to Ethereum, this is a weekly chart. We are below our 9 and 20 SMAs. We don't have longer moving averages on here on the weekly chart because we don't have enough price data. It only goes back to 722 this past summer. So if we drop this down to a daily chart, now we have an extra moving average, this 50 period moving average, because we have enough data for it on the 6-month daily chart, and we are down below the 9, the 20, and the 50. Not a great look. If we do break down below the low of this base right here around $19 or 19.22, we're probably heading back down to 17.50 or testing the 6-month low at 16.73. Going out to our sector ETFs here, this is XLB for our materials. Again, Same thing, rinse and repeat, big red candle pushing down into the top side of our moving average here, the 50-period moving average. This is a very important consolidation right here, and I'm going to redraw these lines now that we have a little bit more information since those were last drawn before I took my time off from trading. And really, we have this little wedge or zone right here, basically between these two parallel lines, roughly parallel lines. If we do break below that drawing right there, that is a lookout below and probably coming back down to around $83. If we go out to XLY, this is a confirmed top and rollover. We had decreasing highs. We now have, I think, a lower low this one was a low of 218.30. This one was a low of 217.52. So we now have an established lower low, lower high, lower low pattern that is technically a short-term bearish downtrend. If we toss this out to a weekly chart, we have broken our moving average here on the all-important 20 SMA at 220 and 10 cents. So we are below that. This is a lookout below. I would be interested to short this probably from 220 down to 200. So this is going to be marked and going on my list. If we go out to XLK, we are just chopping around at the high end of the chart. I don't really see a trade here on the weekly chart. On the daily chart, you could make a stab at it to come down to the 200-period moving average around 225, but I like XLY a little bit better. Going out to XLE, kind of a choppy mess, hard to decide where this wants to go at any given time. We do have support from a lot of moving averages down here, so I'd have to say the nod is slightly to the bulls. If we put this out to a weekly chart, the bulls had gotten back up above all the moving averages, but actually wicked back down and is right in the middle of this cluster of moving averages if I zoom in right there. So I don't think that there is a lean one way or the other, and I would have to wait to see more data. If we do break down below about 89.50, I would give the nod to the bears at that point. Going back out to XLU. XLU, we do have decreasing highs here. That's not a great look. If we go out to the weekly chart, we can see again, yes, we do have a lower low and a lower high. If we can break out and move back up and retest this high, it'll change the pattern. If we roll over, I'm guessing we are going to go back down and retest the 50 at around $74. Going out to XLP, consumer staples. We had a great week on XLP, one of the actual standouts of the entire marketplace on that weekly chart. And look at Friday's candle here. Now, it shouldn't be any surprise the consumer staples had a great day when the rest of the market was getting concerned and weakening its hand and getting nervous in the market, because staples are things that consumers are still going to have to buy regardless of if the economy gets bad, right? So this is not discretionary. This is not going out and buying a new iPhone or upgrading an iPhone or getting a new car or anything like that. This is food. This is stuff that you absolutely need to live a normal day-to-day life. And so that is going to go up because money is rotating out of discretionary sectors and moving into more defensive areas like consumer staples. I would not be surprised to see this break out of our little, excuse me, to break out of our descending triangle here and move back up into around $83. Excuse me. Going out to XLC on the daily chart here, not a great look. Going out to weekly chart, we did end up actually breaking out and confirming with this. A lot of traders probably confirmed into that, but we got a smoke show on Friday last week and ended the week lower. We do have our RSI rolling over. Our MACD is technically in bullish territory, but to me, it looks like it's weakening. And we can see that from the histogram portion right here. This bright green with a little bit bigger of a bar indicates that there is a larger difference between the signal line and MACD line. This little green here, the lighter green right there, you can see shows that the distance between those two lines actually decreased, meaning that there is a chance that this might roll over once again. And that is my base case for communication sector. So I am staying away from communications right now, and I might actually get interested in adding this to my short list later. But again, I like XLY more right now. Going out to industrials. Industrials, if we toss this out to a weekly chart, we have the lower low, lower high. Then we have a little bit of consolidation here the last couple of weeks. We need to wait and see how that pans out. But to me, a break below the 50 period moving average on the weekly chart around 130 and change would signal a top confirmation. And at that point, I would expect price to come down to 120 or below. Going out to XLF, kind of similar story. If we toss this back to a daily chart, a lot of chop and consolidation here. And to me, I am assuming that this is going to continue lower for a little while, just based on the RSI and the MACD both rolling over and showing strength to the downside. We are at the top of the chart here. Putting that back out to the weekly scenario, this could be in the realm of a double top, even though we had a higher pivot here. It wasn't by much, and our indicators for momentum, our RSI and our MACD, are rolling over. And look again, they are diverging, right? Divergence, we talked about this already, lower pivot highs and corresponding price points of higher pivot highs on the price chart. That is signaling that there is not a confirmation from our secondary indicators of what is happening on the price chart, and it's a sign to be a little bit wary. Going out to XLV. XLV, interesting here. It's struggling to break out. Our RSI and MACD are actually starting to turn positive and improve a little bit. This isn't actually that unpredictable either. Similar to our consumer staples area of the market, this is one of the more defensive areas where money might rotate into healthcare because, again, people need to spend money on healthcare when they need to spend money on healthcare, right? That's not a shock. It's not something that is going to go away just because the economy is softening a little bit. So this is an interesting place for me. If we put this out onto the daily chart, remove that line, I would probably draw my confirmation or line in the sand somewhere right there. So a break over 149, let's call it, would be signal to the upside. And that would actually be an inverted head and shoulders pattern here. So inverted head and shoulders pattern are usually reversal patterns found at the lower end of a downtrend. So we had a downtrend right here for the last like 5 or so months. Lower lows, lower highs, lower lows, lower highs, but something happens with the inverted head and shoulders pattern. You have a lower low and a lower high, you put in a new lower low, and then you come back up and put in a relatively equal high, breaking the series of lower highs along the way. Then you consolidate or pull back. Typically, with a head and shoulders pattern, you would pull back down into a similar pivot point from the left shoulder. So this is the left shoulder, the head, the right shoulder. If we break out of that line here around 149, that is technically going to be a buy signal. So I am going to mark this as well, but for the bulls this time. Going out to XLRE, this is real estate ETF, dropping this out to a weekly chart. I'm not super interested in this one way or the other. I think we've identified better trading potential for both the bulls and the bears. So I'm not going to do too much here other than saying we're kind of in the middle of a jumbly mess on the weekly chart for our moving averages. Our RSI is in bearish territory, but kind of improving slowly. Our MACD is in bearish territory as well, but improving slowly. So I don't see a potential trade there. So we're going to move on. Going out to gold, if we drop this back to a daily chart, we are high basing on gold the last week or so, tight range at the top end here. We have had a monster run though, and we are seeing the RSI in overbought territory, meaning this is probably overextended to the top side and needs at least more consolidation, if not some pullback. And our MACD is actually rolling over. So I am not looking for gold to be moving significantly higher in the next week or two. I am assuming more stability or a slight pullback into the 20 and basically just chop between 272 and down to somewhere around 263 on gold. Going out to silver, kind of similar story, but a little bit more chop and a little bit more volatile than gold. We didn't have as good of a run and it wasn't as clean of a run to the top side, but we've had these big red volatility candles come in and we are rolling over on our RSI and MACD. So I am not convinced anymore that silver is ready to run. I had been thinking that we were going to see kind of a head and shoulders here and then a breakout higher back up to 31.8. I am not really seeing that in the cards much anymore. Going out, look at the US dollar real quick before we shift gears, put this out on a weekly chart. The US dollar is finally starting to break down and lose some of the momentum here. So it'll be interesting to see how that impacts equities and specifically commodities. Our RSI on the weekly has crossed into bearish territory. Our MACD is in bullish territory, but we've had a bearish cross. So that is a warning shot across the bow. So keep that in mind. Finally, let's go out and look at our heat map and economic calendar. This is Forex Factory's 1 week performance. So this is looking at the percentage gain or loss of companies in the S&P 500 over the last trading week. And we can see Friday's price action was enough to blow a lot of the big tech names like Amazon and Tesla and Meta and Google and Avgo, CRM, all of them down more than 5%. Palantir down 14%, CrowdStrike down over 10%. So you can see a lot of blood coming into the market, especially in those big high-flying tech stocks. And also, if I move my little video right here, financials sneakily rolling over. So again, we kind of looked at the financials chart XLF and thought that it might be time for it to roll over. And this is confirming that a lot of the weakness in the marketplace this last week did hit financials in addition to tech. So those are the two places that I am most interested in right now to the downside, in addition to what we marked here as well in the consumer discretionary area. Finally, last but not least, let's go out to the Forex Factory. Right now, this is something interesting. So right now, it doesn't look like we have much economic data coming out this week. This is a very docile week compared to what we have had the last few weeks. But one thing I want to call everybody's attention to, notice right now, Monday has nothing. Tuesday just has consumer confidence report. Wednesday has nothing. Thursday, GDP and unemployment claims. And Friday, core PCE. Now, I don't see anything about Trump speaking anywhere on this right now. If we go back 1 week and look at last week, we didn't have President Trump listed as a speech that would impact the market at all going into the week last week. But every one of these different speeches got put on the calendar partway through the week, usually 24 hours before that speech was actually scheduled to happen. Meaning, we don't know if that's going to be the same thing this week. Are we going to have to navigate a bunch of press conferences or things coming out of the White House that might drastically change our perspective this week? It is a reason to be cautious in the market. If we go back another week, so this was last week we just looked at, let's go back one more. And you can see that started here as well. Trump speaks, Trump speaks, Trump speaks, Trump speaks, Trump speaks. Almost every day the last 2 weeks, we've been getting big announcements out of that that can potentially rock the market. Going back one more week, we don't really see that at all. We see one of them. Going back one more, we don't see any. So he is in a mode right now. He's in a mood to stir things up, to make big announcements, and he is pushing really hard right now on his agenda. And that is going to be something that we as traders need to navigate. And even though it's not showing up right now, we need to be prepared for that. Keep your stops in place, trade efficiently, trade effectively, trade safely. Let me know if you have any questions. Hit me up in the comments, hit me up in our Facebook group. If you have not liked and subscribed to the channel, please do so. And if you want to join the free Facebook group where I put out tips and tricks and am just available for you as a resource, if you want me to look at charts you are looking at, join. The link is below, and I will see you guys next week.